Hello class, how you doing? It's a wonderful day out. In this scenario, we are going to use velocity banking inside of an insurance policy. Okay? And what I'd like all of my students to do, especially if you're someone that filled out a form, that means you took action. You want to take the next step in either killing debt, increasing cash flow, building your credit, creating wealth, leaving a legacy behind. One of the five or six, right? Or all of the above. Okay? I want you to get a book just like this, alright? Because I'm gonna produce a lot of scenarios. Okay? So for one half, I want you to have for velocity banking, which is killing debt, using unsecured lines of credit or credit cards to pay off things like mortgages, cars, student loans, personal loans, anything that is labeled as a bad debt, which is an amortized debt. Okay? And then the other half, I want you to have for insurance, velocity banking inside of insurance. Okay? And as I get older and wiser and learn more and make more money and produce more revenue in my business, I'll then talk a little bit more on real estate, because that is another avenue that we can do velocity banking in very, very simply by flipping properties, right? Many real estate investors do that, and they apply the velocity banking method. So those are our three areas. But in the beginning, as you and I are both building, right, to then have the ability to contribute back to people, to help people, and build other people's lives or build your business. Okay, in the meantime, we need to focus on paying debts, increasing our take-home cash flow, right, and then focus on securing wealth, right, having that guarantee and not chasing ROI. We're focusing on a guarantee, which is the thing that makes us happy, and then tying a personal financial vehicle to roll with that. Okay? So in this scenario, we have a 22-year-old. Okay, it's my very, very close friend. She's my best friend. And she's like, all right, Denzel, let's do it. So she likes to, invest in stocks. That's her thing, trading. Okay, so that's the thing that makes her happy. She's going to focus on killing that, crushing it at that, right? While she's, in school, doing her thing, learning. That's her time and focus. Okay? So 22 years old, putting in $6,000 a year into her savings asset, into her insurance policy, right? For 33 years, the number is $198 grand. Right, over the course of 33 years. Okay? So I can easily shake her hand and say, I'll triple that. Whatever you put in, I'll triple it over the course of whatever funding period you want. Okay? Triple it. We'll shake on that. Her cost is going to be $50,712.09. That is the cost of insurance, which would be that death benefit portion. Okay, so by the time she's 55 years old, she'll have well over $1 million death benefit. Okay, and as she gets even older, the death benefit will continue to rise even if she stops funding it. Okay, it'll continue to rise, and so will her cash. Okay, and that's the beautiful part right there. Now, she is only going to get charged a flat insurance premium. It will never change. It will never go up. It'll just stay the same for the amount of time that she funds the policy. So if she wants to fund it for 20 years, cool. After 20 years, she'll never pay a premium. If she wants to fund it for 50 years, cool. After 50 years, she'll never pay a premium again. She'll not only own the asset outright, but the asset will continue to grow, right? It's liquid, meaning all the money that she put in, she can take out at any time. In the 33 years or even after, she can take the money out at any time and use it to do what? She can trade, right? She can, I don't know, maybe she wants to dip into some real estate and buy some land, whatever she wants. When she pulls from the money, it's as if she never touched it. So now she's got money working in two places. This is how velocity banking truly works when we start leveling up in our personal finances, right? So it also provides her this safety net, right? Where if she don't want to trade 1 week, 1 month, 6 months, go on a long vacation, and she doesn't want to be bothered with trading, guess what? This money continues to grow no matter what, right? So this is passive. This is her activity. All this going on is her activity, and this is her passive. And we'll get to a point where the passive exceeds the activity. That can happen sometimes, and we want that to happen, right? And the other beautiful part is this continues to produce cash, tax-free, right? So when we look at cost, when you spread that out over 33 years, right? Because this is not obviously all in 1 year. No, it's a 33-year premium, right? Just divide 50 divided by 33, you're gonna get like $1,500. Okay, that would be her premium for the year, which not only provides this death benefit, which is high, in the event something happens to her, okay, and she has this cash that she can pull from while she's living at any time, okay. She has the ability, right? Because we know if she gets really good at trading and masters what makes her happy, right? She's gonna have more than $6,000 to store away, right? To play with, to invest, to do whatever she pleases, okay? So with this example, she has the ability to put in a little over $17,000 per year, any given year. And guess what? Her cost stays the same. It does not go up. This is where you beat all your mutual funds and all your 401ks and the Roth. You especially beat the Roth because you can only put so much inside of a Roth, right? Now, if you're even smarter, you can go self-directed Roth, but you still have a limit to how much you can put in that, but you are in control of your investments, right? Now, if you were to compare it to a 401k, yes, there's a higher amount that you can put in, but it would match your income, okay? So there's a limit there. With this, there is no limit. She sets the limit. So if she wanted this to be 30,000, she can set it to be 30,000. If she wanted it to be 100,000, she can set it to be 100,000. And this is why rich, ultra wealthy individuals call this asset the rich man's Roth. Okay? It's called the rich man's Roth. Okay? Where you have unlimited deposit amounts, no tax on the growth of your investments, no tax when accessed, right? And any money left over for your heirs cannot be taxed though, right? And this is why ultra wealthy do what they do. And it's my mission in life to crack the code and figure it out. How can someone at a beginning stage get in that process of getting there, right? How can someone at 22 years old, at 40 years old, at 50 years old can accomplish this in their lifetime, where not only do they fulfill themselves to be happy, but now they leave an inheritance for their children's children. They secured wealth for their living years, retirement years, and well after they're gone. So that's the beauty portion here, right? So even though she's a trader, she's not dumping all her money in here, not forever. Of course not, right? She's smart. She's gonna, strategically invest and produce an amount that gets her happy. And it's like, okay, cool. This is what makes me happy. All right. And then she takes a portion of that, stores it away, right, where it will continue to move and make money and move and make money, right? And she has no limitation. She can overfund it and not pay any more cost or fees, right? She doesn't have to worry about that. Doesn't have to worry about cost. My marker's dying. Okay? She doesn't have to worry about that. Isn't that beautiful? Right? And at any time, we can use the money. Okay? Now, the velocity banking portion, how that works inside of an insurance policy is when she goes to pull from it, she's borrowing from herself, which avoids a taxable event. Right? So she would be taking out a loan against herself. So she's borrowing from herself to now go invest in here, produce even bigger returns, or if she wants, she can invest in land and property and real estate, right? And for the money that she borrows, since it's a loan, she would have to pay interest, am I correct? Yes. But see, what happens is, for example, if she's got $200,000 inside of the policy and she takes $150 to then go put in this investment over here, and it's going to produce X. For the amount of time that the money is out of the account, right, she's going to owe interest, simple interest, by the way, very important, not amortized. Like I always say, we don't want amortized, so simple, okay? At the same time, if she has $200,000 in cash, guess what? She's earning the interest rate on $200,000. So we have this arbitrage effect. And if she has a structured policy correctly, the money that she took out, the $150, would earn a higher interest rate to offset interest costs. So this becomes an interest-free loan. Very, very important. See, when I'm doing velocity banking scenarios, we have a line of credit or a credit card that we're using, right? One of the two, okay? No matter what, I gotta pay interest on them. So how do I offset that? By paying another debt to provide a cushion for me to offset the cost on that. Same thing in here. So what she would be doing is she'd be taking, chunks of money out to go put in properties. Those things produce a profit plus the principal. What does she do? She just puts the principal right back, right? Has the profit right here to then put it in here. Oh man, you listen to me, right? And the money continues to grow and grow and grow and grow. Whereas if she was to put her money in an investment account that gets locked up till she's 59 and a half, that money she can't velocitize. If she were to pull from it would you agree she would get taxed? Yes. Even if there was an investment account, right, which I'm sure there are some, where you're able to pull money out. But what happens when I do that? The value of the investment account goes down. If that goes down, then my interest rate would go down because it's only earning interest on a lesser amount, right? And on top of that, I have to pay tax. And on top of that, I gotta pay a fee, right? So I hope you guys really are able to grasp the concept of velocity banking even further, using it throughout your whole entire life to secure wealth, leave a legacy behind, pay off debts, right? And we continue to move forward on this channel to reach more people that need financial help, right? That need assistance. And it's my goal to continue to produce different videos, different ways of explaining it every single day, coming at you, easy to digest videos, little comedy in between. We're happy, we're having fun, we're helping each other out, okay, and we're giving to each other to make things happen, right? So I hope you enjoyed that. My name is Denzel. Thank you for joining me today, and you enjoy the rest of your day. Thank you.